Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with someone who has survived a mutual fund to ETF conversion. Matt Barry, CFA, is Vice President of Product Management and Head of Capital Markets at Touchstone Investments. Prior to joining Touchstone, he was with Western and Southern and Credit Suisse. He got his bachelor's degree from Clemson and his MBA at Duke Fuqua. So, welcome to the podcast, Matt.
Hey, Rob, thanks for having me.
So I'd like to start with your path through this conversion, which I'm sure had many turns and unexpected things happen. So just take it anywhere you like.
Yeah, so we did our first mutual fund to ETF conversion last year. It took a good portion of the year, and then we finished it in December of 2023. So overall, it went very smoothly. I will say that it was a lengthy process because at the time we started, there wasn't as much of a roadmap as far as an industry. There just hadn't been that many conversions before. So working with our service providers, like our custodians, and figuring out kind of all the different parts, the moving pieces that need to happen, took a lengthy amount of time. We had to proxy because of the nature of that conversion, which was significantly timely. But once we got that done, it converted successfully. We worked really closely with our distribution partners that had distributed the mutual fund and had assets on their platform,
Right.
to make sure that they're able to convert it. Typically, how that works is it goes into the weekend on a Friday as a mutual fund. Obviously, they have months of notice for this, and then
Right.
they work over the weekend to make sure all the plumbing gets into place to where on Monday it's an ETF, and then it actually lists on the stock exchange.
Okay, so let me zoom in on a few things here because you made it sound really easy and it can't be that easy with all due respect. So when you started this out, there wasn't much of a roadmap for this. So did you spend an obscene amount of money on lawyers or like how did you get around that?
Depends on how you define obscene.
Yeah.
I'll say we worked very closely with our lawyers. We've got fantastic outside counsel. They were tremendously helpful in kind of guiding us throughout the whole process. Back in New York, as our service provider, they were very helpful. I think we were their second one. Their first one happened like a month or two before us. So we were actively trying to not be the first and learn lessons from the first. But they were both very helpful. But thinking about things like shareholders that need to set up brokerage accounts and how you handle that were some of the kind of in the weeds details that there were some examples before us, but now there's been over 80 as an industry. So it's a much more well-trodden path at this point than there was a year ago.
Okay, so let's dig into the plumbing there. So you have to get the accounts themselves didn't need to change. It was really just the type of the asset type and some of the reporting, I guess, from their experience.
Yeah. So on the front end, we did a lot of work as far as looking at our lineup of mutual funds, figuring out which ones could be good candidates for conversion to ETF. It's not going to be every fund for a variety of issues. A couple of the key things you want to look for are there a lot of retirement plan assets? If there's a lot of 401k plan assets where ETFs aren't really set up to work significantly in 401ks, it might not be the best fit.
Yep, that's logical. Yeah.
The other one, if there's a lot of direct accounts that don't have brokerage accounts, then those shareholders need to actually go set up a brokerage account to be able to hold the ETF.
Okay, so that's probably a pretty small number of clients, right?
It was a small number on the fund we converted, and that was very intentional. There are other funds within our complex that it could have been a much larger portion of the account of the overall fund, and it would have been a challenge.
Okay, so those clients are holding those in LLCs or LPs or some other kind of vehicle like that?
They hold the 40 Act fund, but they interact directly with Touchstone in our case. So they buy
they're
it
cutting the middle
instead
person
of going
out.
through
Right.
Fidelity or Schwab or one of the brokerages.
Right.
They hold it directly with the fund company. So they would need to set up a new brokerage account based
Okay.
on how ETFs work.
Okay. And what about the reporting? Did that require much in the way of changes, or was it you already had some, so you just kind of switched it over on your side?
Yeah, that part wasn't too bad. The service providers do a good job thinking about the kind of the TA and how that aspect. They have a lot of experience handling it like an ETF, so it's just kind of switching it from fund to ETF, but not a lot of complexity there.
Okay. And now let's talk about the clients for a second.
Mhm.
Was anyone like, no thanks, I'll have my assets back now and I'm going someplace else, or were they all like, yeehaw?
I'd say overall the response was very favorable. We had very strong retention, hardly any asset runoff. Which anytime you make a change, whether it's a sub-advisor change or a vehicle change, you expect some attrition. We had very little of that. The fund's about the same size after the conversion as it was before the conversion. I attribute that probably the biggest thing is communication. We reached out proactively to all our distribution partners to give them a heads up, months long in advance, so they could basically, because there's a lot of work on their end. Things like setting up a brokerage account, like we talked about, make sure that all the reporting is set up on their side, not just on our side. But if you give them 2, 3 months of a heads up, then it ended up being a pretty smooth process.
Yeah, and I would imagine that experience was also probably repeatable for them down the road, right? So it's not like they're just one and done. They're going to be able to use this experience.
Yeah, they expect conversions to continue. And our experience talking to our distribution partners, it was a very mixed bag on how they feel about conversions. Some were more against it, that said, well, clients bought a mutual fund. We think it should stay a mutual fund. It's
Right.
more work on our end to convert it to an ETF. I'd say more of our distribution partners were more positive than that. They recognize the benefits of the ETF vehicle and the tax efficiency,
Yeah.
coming out with a lower cost than they were
Right.
before the conversion, and
Right.
and see how it's in the best interest of the shareholders.
Yeah, it really is. When you knock a few, couple of bips off of here and
Mhm.
there, it comes out to a lot. What do you think is behind that resistance, that other than just the clients asked for a mutual fund in the first place, so they should get one? Or do you think that's reticence to change as a whole, or what do you think is in that?
Yeah, it's a little bit of everything. So I think part of it is reticence to change as a whole.
Mhm.
Part of it is it's just extra work on there, and they've somebody's got to come in on Saturday and make sure things
Right.
are changed.
And their salary didn't go up during
Yeah, that's
Saturday.
right.
Yeah.
I think part of it is related to the economics. If
Mhm.
you look at the active mutual fund industry, historically, that's had revenue share and
Yeah.
sub TA expenses, and a lot of costs baked in that our distribution partners just have associated with that vehicle. How that plays out in the active ETF world is still being determined. I think we'll see that, whether they recoup that revenue through data packs or through revenue sharing. So, sub TA is a little bit different because TA works different in ETF than it does in mutual fund.
Right.
But there's an economic component where a lot of distribution partners are figuring out how they're going to handle rev sharing on ETFs.
Yeah. I mean, this is through every transition I've experienced in working in financial services during my career, we always had to learn how to do more with less. Right. I remember when I started in the old 90s when everything was kind of fat margins, everything was easy. So required you to become a little bit more complicated as you get move along. Um, I guess one of the things that I'm curious about as as you think about this is like the there's the sort of growth of the ETF space. There's the balance of the needs, but one of the things I'm really interested in is could you describe what the you think that the impact of all these changes is going to be? Where are we headed with
Yeah, I think we're in the early days in terms of the shift towards active ETFs.
this?
So I'll give a little bit of background there. That's a
Yeah, let's decide. Yeah, because I'm sure a couple of people listening to the podcast just said, "What's an active ETF?" So maybe you can start there.
Yeah.
So-
Yeah. So historically, a lot of people have associated passive and ETF almost synonymously
yep.
because
Yep.
most ETFs were passive.
Hmm.
But the fact is that ETF's really just a wrapper or a vehicle. I use the analogy of a shoebox.
Hmm.
An ETF or a fund is the shoebox, and what you have inside it is a pair of shoes that in the mutual fund world, it could be active, could be passive, could be fixed income, could be equity. That's
Yep.
really what you're buying. It's just the package
Yeah.
that the vehicle
Could
is.
be alternative strategies, and now there's a lot of things in there. Yeah, so
Yeah,
yeah.
that's right. Um, so active ETFs were a very small part of the market. The biggest thing that changed that led to an acceleration of active ETFs, I think, was the ETF rule.
Right.
So Rule 6011, the SEC adopted it in 2019. It did a couple of really important things. One is it made it a lot easier to come to market with new ETFs.
Yep.
So formerly, you'd have to go to the SEC for an exemptive relief. It was costly, it was cumbersome and time consuming.
Hmm.
Now it's a much more streamlined, efficient process.
Yep.
And then the second thing it did was provide access to the full toolkit of ETFs to managers across the board. Anybody that relies on the ETF rule can now use things like custom baskets when you're doing in-kind redemptions that really
Right.
promote tax efficiency. And
Right.
before, that was only available to a handful of issuers. It wouldn't have been broadly available.
Right.
Being able to really utilize those tax efficiency benefits was an important step.
Yeah, that was a real benefit for working with the very largest of them. Right. Because
That's right. They got the early approval to use those. It wasn't given across the board. Now everybody can use
Right.
them. And so since
Right.
2019, what we've seen is a lot of active managers that have distributed their strategies historically through mutual funds come to market with ETFs. And the benefit of that is really just being able to offer the things investors like about active management, the ability to outperform or the ability to protect on the downside, and package that in the vehicle of the ETF with a little bit of a cost advantage, the tax efficiency where you're not paying cap gains distribution in years typically as you would be in the mutual fund wrapper, and then also the liquidity and the transparency benefits as well.
So I guess one of the things that I'm super curious about. Well, let me back up for 1 second. So there's different use cases. We were talking about the variety of things that you can put in the shoebox. What do you think is, I think it's exceptionally interesting to think about active ETFs as they apply to emerging and frontier markets. So how are you all thinking about that?
Yeah, I think that's going to be a big area of growth. And the conversion we talked about, the dynamic international ETF was our first fully international ETF.
Hmm.
I think it's a really compelling space for active managers. International markets are oftentimes perceived as less efficient. There's less analyst coverage, an area where active managers can really potentially add alpha. It's also an area where investors typically aren't, direct indexing or picking individual stocks as much because there's a lot of complexity to holding foreign ordinary stocks.
Yes.
So the advantage of a pooled vehicle that can deal with all those custody issues is significant there. It is operationally more complex. That's why a lot of issuers, ourselves included, started out offering U.S. equity ETFs and fixed income ETFs. You
Mhm.
kind of start with the simpler building blocks, and then about a year and a half later into our process, we were a little bit more mature operationally. Then we came to market with international ETFs.
Okay.
So I think you'll see that from other issuers now, kind of starting out in the U.S. and fixed income space and then expanding internationally. There's really not as much product. There's not nearly as much product in the foreign market space in the active ETF land. If you look at categories like foreign large blend or diversified EM, it's 20 to 30 products there. So it's a relatively small product set that I think will grow over time to meet that investor demand.
Yeah, I think it's also interesting because I do a lot of work with our asset owner series here. So I talk to a lot of asset owners about the problems that they have investing in these regions, and one of them is just scale.
Mhm.
This, if a larger market like this could solve some of that scale issue, because they don't want to, first of all, pile into a market in which they are most of it, and most of them are going to look for fixed income investments first.
Yeah, that's right. It's an area where pooled vehicles, I think, make a lot of sense because of the complexity to invest in for an individual investor. It's just a big headache to open up those custody markets,
Yeah,
and being able to access them with the tax efficiency of the ETFs is a very compelling case.
yeah, and it is also interesting as well, I've said this every year during my time. If sometime there is a convergence between the performance of frontiers, emerging markets, and developed markets, it'll happen someday.
Mhm. Yeah,
Not this
everything
year.
goes in cycles.
That will also be an interesting diversification play
Mhm.
for a lot of clients of many different sizes in the U.S. for
Yeah.
sure. Um, well, I guess this is the other thing because we're talking to a lot of people who are employed in the financial services market on this podcast. And the changes I mentioned earlier have been wrought consistently over time. This is a big one. So if as you look down the road and you see the number of mutual funds decline and the number of ETFs rise, what do you expect to happen?
Yeah, so I think that's the direction we're headed. Right now, so far this year, over a quarter of ETF net inflows have been from active ETFs.
Right.
So you go back 5 or 10 years, it was a small fraction of that.
Yeah.
It's still a small portion of the assets, though. It's only 6% of total ETF assets. So
Right.
I think we're in the early innings, and it's going to continue to accelerate, and that number will grow over time. In terms of what that looks like or what happens, I think there's a couple of reasons where call them exceptions or unintended consequences. But some asset classes might not make sense for an ETF, something that's more illiquid or small cap names, for
Okay.
example.
Okay.
So one of the things that a lot of people don't realize is you can't close an ETF for capacity reasons the same way you can a mutual fund.
Right.
So high conviction active managers, if you have a small cap fund that reaches a couple $1 billion and you want to protect the ability to add alpha, typically what you'll see is managers close that, limit the size of the fund, so it doesn't grow to 5 or 10 billion and potentially jeopardize the ability to outperform.
Right, because the manager has to start choosing names that they might not want to.
That's right. Instead of
Yeah.
investing
So,
in their 50 best ideas, they might have to look a lot more like the index,
right.
and it's obvious that makes it difficult to outperform. Um, in ETF world, you can't close it. You need to keep that. The authorized participants or APs need to be able to create and redeem the fund perpetually to make sure the NAV is trading, make sure it's trading close to the NAV. So that's why when you look at a lot of the ETFs that have come to market, it tends to be larger cap products that you're comfortable with if they grow, significantly.
Right. So you would expect the small cap market to become more difficult.
Yeah, the small cap is going to be a hard nut to crack for active ETFs because of that issue. There could be ways around it. I think what you'll see is some managers, especially some of the biggest managers out there, that are just comfortable with looking a lot more like the index. Um, and you can debate the pros and cons of that approach.
Right.
Um, you could see a multi-manager approach, kind of pairing several different
Okay.
pods in there.
Yeah.
So we've put some early thought into how you tackle that, but overall, I think there'll probably be a space in mutual fund land for small caps and other capacity constrained asset classes.
Okay. Do you see an impact on once again the emerging frontiers markets? They have some of the same capacity issues, especially if you're talking about fixed income.
Yes. So that's something. Anytime we're launching an ETF, there's the considerations we want to think through ahead of time. So it depends on the strategy there and which markets. There's some big stocks and big countries in the EM space. When you think about China and India and Brazil, there's some pretty large names there. So it's potentially a more liquid space than going down kind of small cap. But when you get into the more frontier markets, it's really capacity constrained. That becomes more problematic.
Yeah, yeah. But it is also difficult because some of those very large companies are also very held by the federal government.
That's right.
So
Yeah.
I'm looking at you, Mexico. so, so, interesting. I mean, have you thought about longer term what impact this might have on people's careers? Is it change the skill set that people need to bring? Do you think?
Yeah, I think becoming familiar with the ETF ecosystem is going to be more and more important. We've done so much training of, for example, our wholesalers that are going out there and talking to financial advisors around the country. And we started this initiative probably a couple of years before we went to market. We brought in outside talent that had ETF sales experience and just doing ETF basics. What are APs and market makers, and how does it trade on the stock exchange, and the premium and discount, bid ask spreads, all those concepts that might not have been that familiar to a lot of people need to be more familiar going forward as ETFs grow and become a bigger and bigger part of the landscape.
Okay. Yeah, that is all fascinating. And I wonder if you think this for those wealth advisors out there who are currently merging, there's a lot of dynamics happening in that area, FA market of the world. Do you think this makes those businesses more viable in a way? Because it's a greater range of stuff they can do.
I think it's in a lot of ways a better mousetrap. So compared to traditional mutual funds, if you're able to offer the same thing but with greater tax efficiency and more liquidity, that can only benefit the advisor community and the wealth management shops that are offering them.
Yeah, because the clients of a lot of those places are extremely concerned about taxes and fees, right?
Yeah.
So like they're too easy things for them to understand. Right?
Yeah,
So,
historically, cap gains distribution are a big pain point that a lot of financial advisors have had. If you have say a year where the market's flat or even a little bit down, but there's some turnover in the portfolio, and you have to distribute a cap gain at the end of the year, that's a tough conversation to have with your client to say your portfolio is down a little bit, but here's the 10% capital gain
right.
at the end of the year.
And make sure you calculate that you're estimated for next year. Yeah,
yeah.
it's
So
not great.
being able to avoid that entirely, and
Yeah.
the clients still pay taxes, but they do it when they sell the ETF
Right.
typically, which I think is a very rational approach.
Yeah, and it does make it easier for their accountant to do things like wash.
Mhm.
Yeah, so because it makes it more predictable. All right. Well, this is exceptionally interesting. Matt, I would like to come back to you in about a year and see how things have grown a little bit and see if your views have changed because this is going to change a lot of things. But so thank you for being here.
Yeah. Thanks for having me, Rob.
All right. And thank you all for listening to this podcast. Until next time, I'm Rob Rowan, and this has been Compound Insights.